Hello and welcome to Business Today Television. You're watching Easynomics and I'm your host, Siddharth Zarabi. On the show today, we take up the latest IMF, the International Monetary Fund statement that India is a star performer globally when it comes to its economic growth and is on course to contribute 16% of global growth. And while that statement has obviously come as a positive, nice surprise, the IMF has also warned about India's debt risks as well as raised some issues with regard to foreign exchange management, both of which the RBI and the government have disagreed with. But to make sense of what this IMF staff review, as it is called, and Article 4 consultation really means and what is the significance of this, we are joined by two of India's most prominent economists, Madan Sabnavis, the chief economist at the Bank of Baroda, and Saugata Bhattacharya, one of the senior most economists. Thank you very much for joining us. Madan, I'm coming to you first on that statement of India being a star performer and contributing 16% to global growth. No comparisons really, but I'm reminded of many centuries ago when it was reputed to be the Sone ki Chidiya in the world. Are these parallels and comparisons accurate?
Recording in progress. India definitely is the leading economy today, and this is something which was proved last year as well as this year. So it's not just a fluke of saying that in 23, 24, India is the leading economy, but we've also been the fastest growing economy in 22, 23. And my guess is that even in 24, 25, India will continue to register growth in the region of around 6.8 to 7%. So given this fact, I think it's but natural for any institution to acknowledge that India is one of the best performing large economies, probably the best performing large economy, and the contribution to overall incremental GDP growth for the world economy is going to come a lot from India. So I think that by the sheer size of India, I think India and China are the two largest economies if you're looking at it in terms of PPP, if I keep America aside. And we, of course, have the potential to perform a lot. And in case India has been doing this, China has definitely lagged ever since we had COVID. I think India will continue to occupy this position. And I should tend to believe that our contribution, the 16% number, should probably also move towards the 20% mark in 24, 25, given the fact that we are expecting things to slow down a bit at the global level, while India will continue to tread this particular path. We're still not on our potential growth of 8%, but we are in this region of 6.5 to 7%, which I think makes a big difference.
Saugata, the point that I want to ask you, apart from your comment on this statement by the IMF, is that several people would say, what does this really mean? What does this imply? But would you agree that statements like this and the fact that this is a ringing endorsement by the IMF actually help to increase the positive investment climate that exists for India in global investors?
So, Siddharth, thank you very much for having me on your show. I've rarely seen a report like this, an Article 4 report like this, being such a ringing endorsement of any country. It's a very rare phenomenon, and for good reason that we know. They have pointed out all the good things: macroeconomic stability, financial market resilience, the use of policies, fiscal policy, monetary policy, financial sector policy, etc., as very potent tools which the authorities in India have used to keep the economy on a stable path. In fact, it has become such a statement that some of the other negatives in the potential downsides that the report points out seem like a pro forma. I mean, when we write reviews, we have to write something on the development areas, etc. So we scratch our heads and think on what to write, and then we come out with something anodyne, and which is probably what this report has also written. But I agree with Madan that from now on, the task becomes even more difficult because we as a country need to grow rich before we grow old. And for that, as Madan said, we have to reach our potential growth rate of 7.5%, 8%. Remember that growing at 7% for a couple of years is probably doable for a young country like India. But to be able to carry on growing at a 7.5, 6.5, 7% for a sustained 15, 10 years requires a lot of effort. And that, I think, is the next stage of our policy development.
Madan, on inflation, the IMF says that headline inflation will gradually decline to target. And what Saugata says, if we take a 15 to 20-year horizon and grow at those rates, inflation and that being moderate and acceptable will be the single most important factor. We have already seen that whenever inflation goes up, the government gets concerned and the RBI starts putting on the brakes, and that is what has happened in the recent past as well. How do you read the inflation commentary that is part of this report?
No, Siddharth, I would tend to believe that India is an economy which typically would have an inflation rate in the region of 5%. Okay, it could go up at certain points of time when there are food shocks, and it could actually go down also on other occasions, like we had when the MPC adopted this particular mandate of 4% inflation targeting, that we did get inflation in the region of around 4%. But given the fact that India is still susceptible to the monsoon failures, and this is something which is happening more than often, that even though we have a normal monsoon, we could still be having certain specific crops which could be failing. And that really adds significantly to our CPI inflation. This is something which is going to nag us. Now, there's a lot of talk of saying that maybe we should change this index, change the weights. But at the end of the day, I think if our consumption basket is broadly reflecting what is there in the index, I think we'll have to accept it. And we'll also have to accept the fact that inflation is going to be in this region of 5% at the best of times. So this being the point, I think we'll also have to be prepared for the fact that monetary policy, that is the repo rate, is not always going to be at a low level. To my mind, an average of around 6%, which is what we've witnessed in the normal times in the past, is a normal rate. And industry, that is the largest borrowers, will have to be prepared for it. Now, what we have seen is that even in 23-24 and a part of it in 24-25, interest rates have been high. That is repo rate at 6.5% and corresponding rates for both your credit as well as deposits. It has not actually militated against growth. Credit growth has been very strong last year, also in this year. It continues. So I don't think higher interest rates is a limiting factor as long as we have the demand conditions, as long as we require that capacity to invest. I think the economy will chug along. So I think the major thing is that top line growth has to be maintained. Automatically, things will fall in place. Inflation will be an irritant. It will cause some monetary action at certain points of time, but I don't think it's going to push back the economy to any significant extent.
Saugata, what is a medium term, if not long term, acceptable rate of inflation that we all in India should be accustomed to and accept? And the reason I ask you this question is that the monetary frameworks for inflation and some of the dogma that exists around it also gets challenged, and I'm sure you'll agree with me that on the street if you pose this question to people, आपको inflation से तकलीफ है कि आप ज़्यादा कमाना चाहते हैं, everyone will perhaps take the option of ज़्यादा कमाई, and that can only happen through growth. So what is acceptable, especially for our policy makers and the RBI in the medium term?
So again, I mean, that's a very good question, and Madan has answered this to a certain extent. As you know, even in the West, in the developed markets, there are 2% target inflation that the Fed, the ECB, and the Bank of England are fighting to get their inflation down to. Even that is now getting challenged. I mean, people are questioning why 2%, why not 3%, etc. I also believe, like Madan, that if we are to become a fast-growing economy, at a sustained fast-growing economy, maybe we need to accept a little bit more than the 4% target inflation. Of course, I mean, it can't go beyond the threshold level because after that, it begins to impinge on demand, consumer demand, etc. So what that level is, I think more research now needs to be done. RBI has already pointed out that it is in the process in the next, when the monetary policy framework is renewed, that this issue needs to be relooked. But I believe that if our economy is growing at 3 to 4% higher than the global average, then probably the inflation level too should be about 3 to 4% higher. than the global inflation target, which is 2% at this point in time. Having said this, there is also another argument for tolerating a little higher rate of inflation, which is that the profit function that comes in from a little higher, so corporate earnings, corporate growth, corporate revenues, corporate the cash flows from corporates, that is a very large incentive for corporates to invest and build up productive capacity, which in turn, actually, if you think about it, tends to create that capacity which brings inflation down to a certain extent. So I think this is something which needs to be looked at afresh, whether that 4% target of CPI target inflation is in fact apt for an economy which aspires to grow at 7.5% sustainably for the next 10-15 years.
Madan, just to take one more question on the inflation point before I move on to some other observations in the IMF report. And this has to do with the nature of our inflation, as well as the fact that the government of India runs, apart from the states, a very large welfare budget every year. And that should protect and does protect a lot of the deprived sections of society. And therefore, when monetary response comes through raising interest rates, it hits the productive or more productive sections. Would you agree with that line of reasoning?
No, actually, I would not agree with it, Siddharth, because as I said earlier, that even if interest rates go up, it's not something which is going to come in the way of investment activity or production activity, because I don't stop producing or I produce less because interest rates are high. Interest as a percentage of turnover for non-NBFC companies, non-BFSI companies would not be more than 2 to 3%. It could be around 7 to 8% for capital intensive industries, but otherwise it would be much lower. On an average, it will be around 2 to 3%. So therefore, my overall cost doesn't actually increase. At the same time, it's possible that we have seen that when this interest cost goes up, part of that could also be passed on to the consumer. So that would be feeding a bit into your WPI inflation numbers, which also gets reflected. But to my mind, higher interest rates, the interest rate per se is not that important. It's a case of saying what's the overall economic environment. That is something which drives investment decisions. Interest rate is something which could be affecting costs, but to my mind, I don't think it has been a militating factor against growth. To that extent, I would say that we need to look at the two things separately.
But it has impacted consumer demand. Higher costs of money have impacted the consumer segment.
No, not really. Actually, no. Actually, Siddharth, if you see, the retail loans have been growing like mad. In fact, even people are taking loans without collateral. The controversy we had over other personal loans, where people are borrowing at a much higher cost rate there because you want to consume. So I don't think people are actually being pushed back by the interest rates. People don't stop buying houses because the interest rate is high. It's an investment I make, and I know very well in 20 years when I'm going to repay the loan, interest rates will go up at certain points of time, it'll come down at certain points of time. So I don't think these kind of spending decisions would be guided a lot by the interest rate. Maybe at a margin, yes, it would be affected. I'm not saying nobody's going to be affected by it, but at aggregate level, to my mind, I don't think consumption is affected by interest rates unless the interest rates move up to a very, very high extent, which is not what we're seeing.
Point taken. Viewers, inflation is a tax on the poor. There are no two sort of issues about it, but perhaps on some other show, we need to compare what was done for the deprived section of society 30 years back or 20 years back. And if we take post reforms, it's very clear that the amount of overall support that is given has substantially gone up, and that should protect some of the worst impact of inflation. But Saugata, I'm turning to one more point which the IMF says, and I wonder if you can expand on this. It says further liberalization of foreign investment can up India's role in global value chains. I thought at least as far as the FDI percentage level is concerned, we have one of the most progressive open FDI regimes. What do you think the import of this statement could be?
I believe I'm equally puzzled by this, frankly, exactly like you're saying, because to a very large extent, our capital account, which is, I believe they're talking about the outflow of foreign investments into the global chains, not the inward flows. So to my mind, even outbound FDI, which we had seen expand significantly, a couple of years back. There have been so many acquisitions, mergers, etc., done by Indian companies looking for talent, looking for technology, looking for markets. So that has already happened. My sense is that they might even be looking a little bit in terms of external debt. So there are certain restrictions on external debt, but I do believe that there needs to be restrictions on external debt, because country after country has got into trouble by building up too much external debt. So I don't think there should be too much play that is given to borrowing funds from outside for whatever. But yes, I mean, if there are actually some restrictions on various, I mean, there are quality control, there are non-tariff barriers, other restrictions that are put in place for Indian foreign investment, Indian outbound investment, that needs to be looked at. I really take the point that India needs to integrate very, very intensely into the global value chains, because that's the largest. 80% of global trade is trade in value chains. So if we need to grow it again, I mean, that I'm repeating this again and again, at 7.5, 8%, a lot of that needs to be funneled through external investments, etc. So, I mean, if there are any infirmities in Indian outbound investments, which is difficult to gather. I mean, there might be small details here and there, but that needs to be looked at very seriously, and those blockages need to be unblocked.
Madan, let me now come to a couple of the issues where the IMF has raised a certain point of view. The staff and viewers, there's a distinction between what the staff that is tasked with conducting this review under the IMF statute, that's called Article 4, and the final sort of view taken by the board. This is distinct. You could say that the staff view is more of the professionals and the board view is sort of more of the broader policy makers. But on the issue of foreign exchange rate management, the IMF has moved from a de facto sort of float to a stabilized arrangement. That's what the IMF has said, and the RBI has strongly disagreed with this claim of excessive intervention by the central bank in India's exchange rate. The RBI has said that this reclassification is unjustified, and this is more of a shorter term view taken on the basis of 7-8 months, and had these IMF economists taken a more longer term view, their views would have been different. So, leaving the technicality apart, explain this issue to us and what is its significance.
So actually, I would fully not agree with what the IMF has said. In fact, I would say it's bordering on being incorrect. Okay, because now what is the IMF saying? The IMF is saying there's been too much of intervention in terms of the rupee dollar rate, and that's why it's been moving in a very narrow corridor of around 81 to 83 rupees. It thinks it should have, if it had left open, the rate would have been much higher because of what was happening around us. Now, if you look at a currency, they're determined by two sets of factors. One is what is happening externally. That is something beyond our control. The dollar has been strengthening because the Fed has been increasing rates. And that is something of a concern which no central bank can sit back and say, I'll do nothing. Because it can create chaos, not just on the currency front, but also it comes on the monetary front. And therefore, the Reserve Bank has a right to be. If you look at the fundamentals, I think that is where I think the IMF has not looked at the numbers, or the way I have looked at the numbers is quite different. In this particular period which we have spoken of, our fundamentals have actually improved a lot. We've had a lower trade deficit, lower current account deficit, more FDI coming in. Deposit reserves have actually increased, partly due to revaluation, but also because of net inflows. So to my mind, I think the rupee has been managed very well by the RBI. And whatever intervention has taken place, which was required, in fact, if the central bank did not intervene, I would say that there would be a lot of chaos in the market. I think the intervention was more to take care of the fact that there were global disturbances happening, all currency rates were depreciating. And if the central bank did not intervene, it will lead to a panic situation where exporters would have were panicky, they would have held back their earnings, importers would have rushed in to buy more dollars, and that would have exacerbated the situation. So I think very well managed rupee is something which the IMF is saying that we're moving away from a flexible to a more managed system, which I don't agree.
Saugata, just an sort of academic point of view, or is there more to it?
No, there is more to it. remember, I mean, this is a fairly well-documented phenomenon in terms of the exchange rate, rupee, dollar, yen, euro, whatever. That these currencies tend to overshoot beyond their fundamental level. So, I mean, all of a sudden there's a huge flow of funds inside, particularly FPI, a portfolio flows. Sometimes there is a debt stop. Sometimes there's a massive outflow of currencies, etc. I mean, foreign currency because of the portfolio funds, etc. So even, I mean, so just the sheer movement, concentrated movement, bunched movements of foreign currency, particularly portfolio flows, tends to create massive volatility in the market. RBI has very correctly pointed out that this is a temporary phenomenon. Now, temporary, 1 year, 2 year, 5 years, or whatever. So definitely over the period of the COVID pandemic, because there was such a lot of inflows and outflows, that you needed to control the currency from overshooting beyond. And remember, there's another problem with currencies. It's driven by expectations. This is not just Indian domestic monetary policy. It is driven by global monetary policy all over. Global investors are participating in this. So the RBI has very little control. The control that they have is in the level of their foreign exchange reserves, which they use to stabilize the rupee. Remember, they're mopping up dollars on the when flows come in, they're building up their reserves. When flows go out, as governor says, it's used like an umbrella. They also use it to control the currency. So I think that is something which is I think which is worth noting. Remember, I mean, as a technical point, I just want to point out that this famous impossible trinity, that you cannot have a fixed exchange rate, free capital movement, capital flows, and control of a domestic economy, which we are now seeing in Argentina, by the way, when they are linking to the dollar. And this is one factor which really inhibits the ability of a central bank to keep it very tight lid on currency. I mean, it has to be driven by fundamentals. Sure, there might be some surges here and there, but that's something for the Reserve Bank, for the central bank to manage and control.
Okay, let's now turn to the final part of today's Easynomics, and this is to try and understand what the IMF means by flagging India's debt risk. What has the IMF said? The IMF has said that both the central government and the state government debt could exceed 100% of the gross domestic product in the medium term. It has also cautioned that long-term debt sustainability risks are high due to the significant investment that is required to meet India's climate change mitigation targets. The government of India, and this is a consultative process, viewers, this is not a one-sided report, has disagreed, and it has said that these concerns are not correct because sovereign debt are extremely limited as it is predominantly denominated in domestic currency. And it's also then spoken about various other issues, including, for example, the IMF view on sudden increase in sovereign risk premia may weigh on the balance sheet and bank lending appetite. India has called that concern far-fetched. Madan, 100%, more than 100%. Now, this is obviously a global issue, and if you look at the total debt that the United States runs, this might pale in comparison. How significant is this matter?
See, the thing is, we should remember that what the IMF is saying is a kind of a standard statement which is made. You always warn countries of saying that you should not be borrowing more. Now, whether this level of 100% is scary or not, to my mind, I think we have an FRBM in place which actually limits the amount of borrowing which can be done every year by both the center as well as states. So let's assume that at some point of time, we'll get to the 3% number. Otherwise, we're talking of a short term of 4.5, states moving towards a 3.5 position or whatever the numbers have been specified. I think that is more important than having control over it. And as was mentioned by you, rather what the government has said is that when all the debt is denominated in rupees, there's actually no sovereign risk which is involved. So the discipline comes in when we have the FRBM and we know that there are limits to which which state governments as well as the center is borrowing. I think that is more critical. The number, of course, will keep varying. This particular ratio which you're talking of, if my denominator, the GDP growth slows down or goes up, then I can have a more favorable ratio. But I would tend to believe that if we stick to this 3.5, 4% number or whatever is the roadmap which has been laid down, I think everything will be under control. I don't think this high level of government borrowing, everybody has been talking of it. I think every international agency, credit rating agency, IMF, World Bank, all says we need to do it. I call it a standardized statement because this kind of borrowing has not really come in the way of either crowding out the private sector, pushing up interest rates. I think we've seen very good management of all. And above all, as I told you, the rupee, it's all in rupees. So therefore, there's no threat which is there to any other country because of foreign exchange which is involved. So to my mind, one should not get read too much into it.
Saugata, I am reminded of the debate and discourse, much of it which happened behind closed doors, when the government of India in the budget indicated towards borrowing overseas, and then finally that plan was dropped. But that's the subject matter of a separate debate. But explain this as simply as is possible to the average viewer, that what is being said here by the IMF, and what does it mean when a government says that most of the borrowing is in domestic currency?
So a couple of things. I think, as Madan mentioned, I mean, there is no foreign currency default risk, right? I mean, many countries have defaulted on their overseas externally funded. We have multiple examples in Pakistan, Sri Lanka, etc. What happens when you borrow too much in foreign currencies, particularly the dollar? So that I mean, it's almost zero in terms of sovereign debt. I mean, there is nothing. Number two, I don't think we are headed towards 100. In fact, the FRBM is very clear. FRBM is not so much about the fiscal deficit as it is about the debt. It is very clear that within the space of about 10 years, I believe, from the current level of 82% of GDP, center and state public debt needs to move from 82 to 60%. That's the target. And I think that's moving. Having said this, I do believe that we need to, this is the one area that I agree with the IMF on this, that we do need to reduce the level of our public sector debt. Because this high level of public, in comparison to even our emerging market peers,
But how would that happen? No, Saugata, sorry to interrupt you, but how would that happen, the reduction of public sector debt?
Because by steady reduction of the fiscal deficit. Steady reduction of the fiscal deficit. The fiscal deficit is the borrowing that the government does every year, which adds to the debt. So if we retire some debt, and the level of debt that we are adding to the overall level of debt via the fiscal deficit, that in addition to the growth, because if we are growing at a nominal growth of 10 to 11% every year, maybe a little bit more, and our fiscal deficit is coming down from the current level, say, of 5.8% of GDP down to the target level of 4.5%. So the addition that we are doing to this level of debt, in addition to the overall growth, because remember, this is a percentage of GDP. So the two together act to steadily bring down this growth. And this reverts back to your question on whether interest rate levels in India are high. I do believe that interest rate levels in India are high to be able to be competitive with our global emerging market peers in the export markets. Besides other costs, logistics costs, etc., costs of power, interest rates, I do believe, need to come down. So together with the policy rate, together with this, the other gap, so that the 10-year GSEC, the 10-year AAA bonds will move together with the total amount of demand and supply in the system. So the overall level of supply, which is the fiscal deficit, that steadily needs to come down.
Siddharth, if I can just say
yeah,
something.
sure, Madan.
See, when you're talking of this level of 100%, I think one problem which I have with most of these multilateral agencies is that they use a universal benchmark for developed as well as developing countries. Now, a country like India, just look at it. All of us accept that the heavy lifting in terms of investment is being done by the center and to a certain extent states, because private sector investment is not taking place. There's a lot of social security which is being provided, all the subsidies which people are talking of, because there are lots of people who are poor. So such kind of countries will be running higher deficits than maybe the developed countries, and they would tend to be having higher debt levels. So I think you have to look at it from that prism rather than just saying that there is something wrong with 100. As Saugata says, I don't think we'll cross that 100% mark. But even if we do, I think given the kind of conditions for emerging markets like India, I wouldn't really be against it if it takes care of both the investment as well as social security which is being provided.
And there's a lot of data on the side of that argument and the argument of the government of India. If you were to take how tax collections have improved, that alone, although there's a lot of roads still to be covered, that alone makes a big difference. But viewers, this is in some ways a significant point of view on which I want to conclude today's show. It's very clear as 2023 winds down that the surround sound and the positivity that exists for India is something that we haven't seen in the recent past. And look at what is happening all around the world, including China, which till a few years ago nobody believed could go wrong. And look at what is happening in several of its sectors, including the real estate sector, just as an example, which has driven Chinese growth. So with the IMF calling India a star performer, pressure on the fiscal and the monetary authority to continue to perform as a star will continue to go up, and we'll keep tracking that with fantastic guests like Saugata, Bhattacharya and Madan Sabnavis. Thank you both for your time today. With that, it's a wrap on today's episode of Easynomics. We'll be back with more. Until then, goodbye.